Hello class. From today onwards, we are starting a new topic named as share capital and debentures. This topic has come into your Companies Act 2013, and under this topic, we will study various terms which are used in this chapter and in Companies Act, and you will become aware of all those terms. So now let's start with the chapter. See, so the first clarification which is given to you is all the rules mentioned in this chapter are related to companies share capital and debentures rules 2014 only. So let me tell you one thing here. See, so Companies Act 2013. This is the main text which deals with the rules and regulations related to companies. Okay, so this is your main text. Now, related to this, some rules and regulations are also clarified by the government. So those rules and regulations comes under Companies Act rules. These rules can deal with different topics, and one such topic is share capital and debentures. So these rules tell us about in detail about share capital and debentures. So some main points are there in the Companies Act 2013, and some detailed rules and regulations are mentioned in these bylaws. Okay, these are known as bylaws, or in simple terms, they help in interpreting the main text, which is Companies Act 2013. Okay, moving back to now, the first thing which we need to understand is what is the meaning of share. Okay, so whenever a new company starts, it needs funds to start, right? So let's say there is a company named, for example, there is a company named ABC Limited. It has newly started, right? So its capital is rupee 1 lakh. Now tell me, if this company wants that public should invest in this company, then what it will do is it will say ki okay, my whole capital I will divide it into shares, and value of one share will be 10 rupees. So this is value of one share. In this way, see, so it is saying that my capital is divided into 10,000 shares of rupee 10 each. It means whenever a company wants that public should come and invest in its company, so for the purpose of distributing the ownership, here what company is doing? 1 lakh is capital. Capital means the fund which is required to start a business. So company is dividing this capital into number of units, so it can be easily divided into a number of persons. If anyone comes, then company can say okay, you can take 10 shares or you can take 20 shares. So in this way, company has divided its capital. So share means to distribute, right? So in this case, company has distributed its share capital. Now let us see what has been given in your notes. See, So they are telling you what is the meaning of share. Just a second. See, so share means a share in the share capital of a company. So in company's capital, what is the share? Okay, so that is known as share. A share is a right. A share is a right to participate in the. See, they are saying share means a share in the share capital of a company. So I have told you that share capital means a company, a fund which is required to start a company. Next, a share is a right to participate in the profits made by the company. Obviously, by distributing shares to the public, many people can come and become shareholders of the company. And by becoming shareholders of the company, it means that they have become a owner of the company, one of the owners of the company. And now whatever profit company will earn, it will distribute between its shareholders. So let's suppose if I have purchased rupee 10 share of a company and I have purchased 1000 shares of ABC Limited. Okay. So now I am eligible to take profit in the ratio of 1000. Just for your example purpose, let me tell you. Let's say there is ABC Limited, right? ABC Limited has 1 lakh shares. Total 1 lakh shares ABC Limited has, and out of this 1 lakh, I have purchased 10,000 shares. So now it means I am eligible for 1/10 of the profit, right? Because I am the shareholder for 1/10 of company share capital. 10,000 divided by 1 lakh is 1/10, right? So this is the logic. Okay. Next, what they are saying is a share is a right to participate in the profits made by a company while it is a going concern. Okay. Going concern means for a company to be a going concern, it must be able to continue operating long enough to carry out its commitments, obligations, objectives, and so on. The meaning of going concern is which keeps on running, right? It means in the foreseeable future, whatever future you can see, in that company is not going to shut down, right? So they are saying is a share is a right to participate in the profits made by a company while it is a going concern. As long as company will run, these shareholders, just like for example, if I have taken 10,000 shares of the company, then I will be eligible to take part in the profits of the company, okay, in the foreseeable future. Now they have told you what is the meaning of going concern. In simple words, the company will not have to liquidate or be forced out of business. Company will not liquidate, will not shut down in the foreseeable future. This is the assumption which is taken in case of every company until and unless there are compelling evidence which shows us that company is going to shut down in the future. Except in that case, in all the cases we will assume that company is a going concern and it will not shut down in the near future, right? Next, now as we have understood what is the meaning of shares, we will move on to the debentures. So before going through the notes, I would like to tell you that shares represent the ownership and debentures represent the loan amount. Okay. So when we are company takes loan from the public, okay, this is a form of taking loan from the public. So what company does is like if a company requires 10 lakh rupee funds, okay, so it will say that, let me give you an example. It will say, okay, I need 10 lakh rupee fund. Company needs this. So company will say, ki, I will divide this into rupee 100. Okay. So what this will come out as 10,000. So company will say, ki, I will issue 10,000 debentures of rupee 100 each. This is a kind of debt instrument whereby company promises to the public that you please come and give me this loan amount, and in future I will repay this amount back to you. Okay. So debentures are also a sort of, but shares represent ownership and debentures represent a liability. Now let's see what does debenture mean. So here they are saying a debenture is a unit of loan amount. When a company intends to raise a loan amount from the public, it issues debenture. A person holding debentures or debenture is called a debenture holder, as a person who holds share is known as shareholders. In similar fashion, when a person invests in a company through debentures, or in other words, he gives loan to the company in form of debenture, he is known as a debenture holder. Next, a debenture is a document issued under the seal of the company. It is an acknowledgement of the loan received by the company equal to the nominal value of debenture. It bears the date of redemption and rate and mode of payment of interest. A debenture holder is the creditor of the company. See, here company require 10 lakh rupee fund. Okay, so company has distributed into 100 rupee debenture. 10,000 debentures company will issue. Okay, this is a loan amount, so it will have an expiry date. By expiry date, what I mean to say is up to a certain period of time, on a certain date, company will have to repay back the amount which it has collected as debentures. So let's say if this amount has been collected in 2021, then in 2030, just for an example, I'm saying in 2030, company will have to pay back, right? In 2030, company will have to pay this amount back to the investors or to the debenture holders who all has given this amount to the company. Along with this, every year company has to pay interest on this debenture, as we all know that whenever we or you take loan you have to pay interest, right? Same in the case of debentures. If company has taken loan in the form of debentures, then it will have to pay interest to debenture holders, right? Next, see, debenture includes debenture stock, bonds, or any other instruments of a company evidencing a debt, whether constituting a charge on asset of the company or not. Next, see, shares and debenture rules are applicable to on which type of companies these rules are applicable. Here, this is discussed. Okay, which rules we are talking about? Companies Rules 2014, which relate to share capital and debentures. So first is all unlisted companies, all private companies, and all listed companies. So what are listed companies? Listed companies are those which are whose shares are traded in stock exchange, right? There are two stock exchange. One is Nifty, next is Bombay Stock Exchange, right? So whichever company share are listed in stock exchange are known as listed company. If company share is not listed in stock exchange, then it will be known as unlisted company. And if a company is not a public company, then it will be known as a private company. What is the difference between public company and private company? So, in private company, the investment is made by the original owners only. Okay. But in case of public company, this type of companies can go to the general public, means to the people like you and me. They can come to us and ask for investments, right? And how they do so? By listing themselves on stock exchange. Okay, so people go and buy the shares like Reliance Jio and your Paytm, ITC. Okay, all these are public companies whose shares are easily available on the stock exchange. Next, see, what is the meaning of share capital? So here they are saying that share capital refers to the funds that a company raises in exchange for issuing an ownership interest in the company in form of shares. It means public gives the amount. See, if you will take an example, see, here this is company and this is public, right? Company gives shares and public gives money. So this is the transaction which happens, right? So in this case, what happens is public gives money to the company and company in return gives shares to the public. By giving shares, company means that now you are a owner in the company. Like I have told you earlier also that if in a company of ABC Limited there are total 1 lakh shares and if I have purchased 10,000 shares, that then now I have become an owner for the 1/10th share. Okay. So by giving share capital, by raising shares, company issues an ownership interest. Okay. Public gets the ownership interest. Whosoever purchases the shares becomes the owner of the company. Or share capital is own capital of the company since it is the money of shareholder and shareholders are the owners of the company. Share capital means the capital which is used to carry on the business. And the person who will invest such capital will be known as shareholder, or in other terms as the owner of the company. Next, what they are saying is total share capital is divided into small parts and each part is called a share. I have told you already that a 10 lakh rupee share capital can be divided into one share of 10 each. So now company will have 1 lakh share of rupees 10 each. That means a 10 lakh rupee share capital. So the whole lot of share capital is divided into small parts known as shares. Next is share is the smallest part of the total capital of the company. If the total capital is 10 lakh rupees, then one share will be worth of 10 rupees or 100 rupees. It depends on the company, whatever the company wants, right? So share represents the smallest part of the total capital of the company. Right. You have to remember this. Next, after understanding share capital, let's move to the rights issue or right shares. See, whenever company requires fund, let's say here is a company ABC Limited and it requires fund. Okay. So now what it can do is it has first option to issue shares to the public. Okay. What does public stand for? People like you and me who are unknown to the company, and company can say that I'm going to issue shares and now you can invest in my company. The next option is also to issue shares, but this time these shares can be issued to the existing shareholders. It may so happen, what I'm trying to say is, company can decide that okay, we already have some shareholders, so before going to the public, let us give the right to our existing shareholders कि you people can buy shares from us. Okay, you people can take up shares and pay up the money. And the good thing about this is these shares are offered at a low price, lower than the market value. If, let's say, if this time ABC Limited share has a worth of 400 rupees in the market, ठीक है, तो to existing shareholders they will offer in 300 rupee per share, lower than the market value. Okay, so that the shareholders can come and take up the shares, and through this route company will not have to go to the general public for issuing shares. Okay, so let's see, this is known as rights issue, when you give the right to existing shareholders of the company to purchase more shares from the company. Okay, so what they are saying is the issue of new securities to existing shareholders. You have to note the terms: new securities. New shares are being issued to existing shareholders, the people who are already shareholders of the company, at a ratio to those already held. Okay, when a company is planning an expansion of an operation, let's suppose if company wants, if there is a company known as ABC Limited, it already has three factories, but it wants to expand its operation and it want to establish two new factories. Okay, so for that it need fund. So it has two options. If first option is it can go to general public, right, and order and issue shares, and the next option is it can go to existing shareholders and issue shares. Okay, so both the options are available. So what they're saying here is when a company is planning an expansion of its operation, it may require a huge amount of capital. Obviously, lot of funds is required to for an expansion. So instead of opting for debt, what they're saying is instead of going for debentures, they may like to go for equity to avoid fixed payment of interest. To raise equity capital, a right issue may be a faster way to achieve the objective. So see, what is the difference between equity, that means shares, and debentures? So I have told you share means ownership. Any person whosoever purchases shares becomes shareholder of the company. It means he becomes the owner of the company and he takes part in the profits. And if there are losses, then he will take part into losses also. He will bear the losses also. But now, what happens in the case of debentures is, in case of debentures, they are the company is the borrower. So company will have to pay interest whether it is in profit or not. Whether company is running in profit or not, but company will have to pay interest. So interest becomes a fixed charge, fixed expense. Okay. So in this case, if I have to weigh both the options, if my company needs fund and I have been asked कि you have to choose between equity and debt, then obviously I will lean more towards equity because in that case risk is less. Whosoever will invest the money will become the owner, and there will be no need of any fixed payments as in case of debentures or debt. Okay, so here they are saying is if for any expansion, if funds is required, then company can go for right issue of share because it is fast. Okay, and it does not involves the payment of any interest charges or fixed charges also, so it is a bit safer too. Okay, a project where debt loan funding may not be available or expensive usually makes a company raise capital through rights issue. So in that case, company can raise funds through right issue. Right issue means I have already told you, when the shares are issued to existing shareholders, then this is known. In that case, company gives a right to its existing shareholders to purchase shares from the company. Okay. Okay. Now we will see the examples of a right issue. Okay. Let's focus here. Let's say an investor owns 100 shares of ABC. ABC is a company and there is an investor who owns 100 shares in the ABC. Shares are trading at rupees 100 each. Okay, so the current market price is 100. The company announces a right issue in the ratio of 2 for 5. It means each investor which holds 5 shares will be eligible to buy 2 new shares. Okay, so this is the ratio which company has used, that whosoever shareholder who has at least 5 shares in our company, they will get 2 shares as right issue. Okay. So now what happens is the company announces a discounted price of, for example, rupees 60 per share. See, I have told you earlier also, to attract existing shareholders, what company does is company announces the right issue price lower than the current market price. Currently shares are trading at 100, right? So company has said कि you are our existing shareholders and you will have to pay only 60 per share. Okay, so there is a discount for you. Next, it means that for every 5 shares at rupees 100 each held by an existing shareholder, the company will offer 2 shares as a discounted price of 60. Okay, so it means for every 5 shares at rupees 100 each held by existing shareholder, company will offer 2 shares. So now see, what will happen is, now they have solved the question, that investor's portfolio value. It means what investment investor was holding. So he had 100 shares and one share of was of rupees 100. It means his investment was worth of rupees 10,000. So next, number of right shares to be received. He already has 100 shares, right? And the ratio is 2 is to 5. So it means he will get 40 shares as right issue. But for to get these 40 shares, he will have to pay 60 rupees for each share. That comes out to 2400. Okay. So the total number of shares after exercising right issue will become as 100 shares he already had and 40 shares he will get. So now it will become 140. Revised value of portfolio, 10,000 was the earlier value and 2400 the amount whatever he paid to get the right issue. So should be price per share post right issue. Now they have done an average, that whatever amount he has paid for total number of shares divided by what is the total number of shares, 140. It has come out to 88.60. So we can say that theoretically the new value of share will be 88. And this also means that new shares that you are buying at 60 each will have a market value of 88. So they are telling is कि right shares which you have bought at rupees 60 will have market value of 88.60. So this is how calculation of right shares is done. Next, after right issue comes the topic of bonus issue. Okay, so what happens in case of bonus issue is, see, here is a company ABC Limited. ABC Limited has earned huge amount of profits and its share capital is currently rupees 1 lakh, but because it has earned so huge amount of profit, it reserves. Reserves means it's a kind of locker in which you save money for your future purposes. Okay, so now see, this is their balance sheet. Now company can think of key, okay, fine. So here are 10,000 shares of rupees 10 each. So company might think we have enough profit here. Okay, we have enough profit in our reserves, and what we can do is we can transfer some amount from here to in share capital in form of bonus. So company, what will company say? Okay, so there are 10,000 shares in our company currently. It means 10,000 shareholders are there, or it can so happen ki less number of shareholders are there. So whosoever is holding one share of the company will get one more share as bonus. So 10,000 shares were already there, 10,000 more shares are issued at bonus, and this will come to 20,000 shares, right? So now the next question which arises is from where this amount will come. So let me tell you, no, existing shareholders will not have to pay anything for taking up bonus shares. In case of right shares, they had to pay an amount, although it was less than the market value, but still shareholders had to pay this. But in case of bonus issue, nothing is to be paid by the shareholders. Okay, these will be given by company free of cost. No cost will be taken from shareholders, but what company will do is company will minus the amount from here. It will take the amount from reserves and this will get transferred to your share capital. Your share capital will become 2 lakh and the amount of reserves will come down to 8 lakhs. Got it? So this way, company has capitalized its profits. Whatever profits it had earned, a part of it had transferred to share capital. So now let's see bonus shares. So see, the bonus share refer to capitalization of profits of the company by issuing fully paid up bonus shares to the members of the company free of cost. Okay, so the difference between right issue and bonus issue is right issue is given by charging a certain amount, but bonus shares are issued free of cost. Next, such shares are given to members in proportion of their holding. So in this case, what was the proportion? 1 is to 1. Whatever shares were held by shareholders, the same amount of shares they received as bonus. Okay. Next, paid up share capital of the company increases with the issue of bonus shares. I have shown you the example. Earlier, capital of company was 1 lakh. After issue of bonus shares, it became 2 lakhs. Next, it is taken as a good sign of good health of a company. It increases the share capital of the company. Now, the earnings of the company will have to be divided by that many more shares since the profits remain the same but number of shares has increased. The EPS will decline. Okay. See, so I'll give you an example over here. Example is the same company, ABC Limited, before bonus issue. Okay, this situation is before bonus issue. your EPS. EPS is earning per share. Okay. Let's say your earning is 10 lakh. Earning of ABC Limited is 10 lakh. And before bonus issue, it had total number of 10,000 shares. Okay. So what was its earning? Rupee 100 per share. But the situation changed after bonus issue. See, after bonus issue. After bonus issue, your earning, let's say your earning remained the same 10 lakh rupees, and but your shares increased to 20,000. So now your earning per share has reduced to 50 per share. So see, now you can automatically see post bonus issue, your earning per share decreases. The earning is same, but if you will increase the number of shares, so it will automatically reflect on your earning per share. This is what is explained over here. Next, see the example. If a shareholder holds 100 shares out of total 1 lakh shares of the stock of company, and company announces a 2:1 bonus issue. Okay, 2:1 means whosoever is holding one share will get two shares as bonus. So in this case, what will happen? This shareholder has 100 shares. So now he will get as bonus 200 shares and his holding will become 300, right? The company's outstanding shares will also increase by 2 lakh. See, earlier company had how many shares? 1 lakh. Okay. Now your ratio of bonus issuing is 2:1. It means 2 lakh. It will become 2 lakh, making the total outstanding share as 3 lakh. The shareholders' stake in the company before the bonus issue was 100 divided by 1 lakh. They are finding out that what was his ownership percentage. So out of 1 lakh shares, he held 100 share. It means he had the shareholding of 0.1%. And after bonus issue also, the shareholding remains the same. Okay. So they want to prove the point is that post bonus issue of shares, there is no change in the percentage holding of the shareholders. If there is a shareholder who holds 51% shares of the company, then after bonus issue also he will hold 51% only. There will be no change in the percentage holding, right? Obviously, there will be a change in the number of shares he's having, but there will be no change in the percentage holding. Next, see, the date when bonus issue becomes effective is called record date. Okay, fine. Next, sometimes companies issue bonus shares to encourage retail participation and increase their equity base. When price per share of a company is high, difficult it becomes difficult for the new investors to buy shares of that particular company. Increase in the number of share reduces price per share, but the overall capital remains the same. So what they are saying is sometimes company issues bonus shares to increase the retail buying and selling of the shares. What will happen is, let's suppose till now ABC Limited has 10,000 shares issued in the market. Okay, now, after bonus issue, ABC Limited will have 20,000 shares in the market. Okay, so obviously, buying and selling of the shares of ABC Limited will increase in the market. Why? Because number of shares are greater in the market. So, one impact is it will have impact on the trading, and the another impact is see all must have studied economics, and if not, then I will tell you, whenever supply of anything is more, okay, so the demand of it comes down and it reduces the price. Just like you can take examples of onions. Okay, so if in any season, if the supply of onions is more, then it decreases its price. Okay, the same applies in the case of shares as well. If the supply of the shares will increase, then automatically the price of shares will go down, and hence it makes way for new investors also. There can be many new investors who want to invest, but due to high prices of shares, they cannot invest. So, bonus issue has an indirect benefit also, that it reduces the share price and new investors can come and invest in the company, because now share price have been reduced and now it is not that much costly to invest in the company. Okay. Next, see. For instance, if investor A holds 100 shares having price rupees 500 per share of a company, and company declares a split of the share into share of 100, means for every one share he will get 5 shares total, 4 bonus without cost. So see here what they are saying is, if a company, if A holds 100 shares, right, having price rupees 500 per share of company, and company declares split of the share into share of 100, means for every share. Now what they are saying is, A is having 100 shares, one share is of rupee 500, but now company is splitting such share. Okay, so after splitting, after share splitting, 500 value per share into 100. So capital will remain the same in share split related bonus issue. Even if you split the share, the capital will remain the same. Okay. Next, let me tell you one thing over here. See, what was happening was, there were he was having 100 shares and one share was of rupee 500, right? But now they have split the share. Okay, for every one share he will get 5 shares total. Now he has 500 shares and the price of one share is 100. Okay, so they have just did the splitting of 50,000 into another ratio. This does not have any impact. Moving on to, now these are some terms which are being used whenever the term share is used. All these terms are used in the balance sheet of the company. Okay, share capital of the company is divided into all these parts, so you must be aware about all of these. See, the first one is authorized capital. It means, in simple terms, registered capital. This is the maximum amount to which share capital of a company can go to. Beyond this point, no further share capital a company can issue. So, what is saying? It is the maximum amount of capital which a company can collect or raise by selling its shares to the public. Okay, so now if in a document of company, if it is written that company's authorized capital is 50 lakhs, so it means at any point of time company cannot issue share capital beyond rupees 50 lakh. That is the limit set by the Companies Act. Okay, it differs from company to company. Okay, every company has different authorized capital. See, authorized capital or nominal capital means such capital as is authorized by the memorandum of the company. So, there are twin documents known as Memorandum of Association and Articles of Association. They contain all the details about the company. What is the authorized capital, who are the directors, who are the owners, and what are the rules and regulations. Okay, so everything is covered by these two documents, Memorandum of Association and Articles of Association. So they are saying that in Memorandum of the company, it is written that what is the authorized capital of the company. Stamp duty is paid on this amount. So whenever company gets registered, it pays stamp duty on this amount only. The amount is fixed on the basis of amount that will be needed by the company as fixed capital, working capital, and reserve capital. I have told you that every company has different authorized capital and it depends on the need of the company. What is the need as per the business done by the company? Along with that, authorized capital is set. So a company is not allowed to raise capital in excess of this amount. If it needs to raise more capital, it has to first amend the capital clause of the memorandum. Have you got it? This is self-explanatory that in case whenever company wishes that it has to exceed its authorized capital, then first it has to change the memorandum of association. Okay, it cannot do so without amending, without changing the memorandum. See, they have given example. Suppose a company incorporated with 1 lakh. So authorized share capital of Messrs XYZ Limited is 10,000 equity shares of 10 each. Okay, so it means XYZ Limited cannot issue shares more than 10,000 equity shares. See, now it is written over here. They have given what is Memorandum of Association. So, Memorandum of Association is the most important document of a company. It states the object for which company is formed. It contains rights, privileges, power of the company. Hence, it is called a charter of the company. Okay, so it contains all the details regarding the company. It is treated as the constitution, like we have an Indian constitution where all the rules and regulations are written, that how India will carry on its government, or what type of government will be there, what will be the relation between center and state. Similarly, every kind of detail regarding a company is mentioned into Memorandum of Association. Okay. Moving on to issued capital. So see, issued capital means such capital as the company issue from time to time for subscription. Now, see in this example, 10,000 was authorized capital. Now, out of it, company can say that okay, I want to issue 7,000 shares. Okay, so that is comes under issued capital. So it is that part of authorized capital which actually issued to the general public. So, such shares may be issued not only for cash but issued for consideration other than cash. So, see, there can be a situation that out of the 10,000 authorized capital, 10,000 shares, company can say, okay, I want to issue 6,000 shares to the public. Okay, and it may so happen that company has purchased a 1 lakh rupee machinery, but company does not have cash to pay to the vendor for machinery. So company will say to the machinery vendor that you can take 1,000 shares from me. Okay, so this is issuing share for consideration other than cash. In this case, company will not get any cash from machinery vendor, but company will get a machinery. So instead of paying through cash for the machinery, company has paid through shares. Okay, this is known as issue of shares for consideration other than cash. So issued capital can also be for cash and for also be other consideration other than cash. Next, so here they are saying that out of 10,000 authorized shares, company can issue 8,000 shares. So issue capital is 8,000 shares multiplied by 10, 80,000. Now, out of whatever the public company has issued, if public comes and demands for it, then only it will be called as subscribed capital. Means company has said that I want to issue 8,000 shares, but applications has come only for 7,000 shares. Only 7,000 people are interested in the shares of the company, right? So, subscribed capital is whatever shares are actually taken up by the general public, that is known as subscribed capital. The other remain unsubscribed, nobody has taken that. After subscribed capital, what is called up capital? Now, let's say 7,000 shares has been subscribed by the public, means application money has been received. But as you know, as you have studied in 12, if a share is of 10 rupees, that company calls the amount in installment. First it will call 2 rupees, then it will call 3 rupees, then it will call 2 rupees, and then 3 rupees, or whatever the amount company decides, but it will not call total 10 rupees in one go. It will call it in installments. Okay, so whatever amount of the face value which has been called up by the company is known as called up capital. So see, they are given here that face value is 10 rupees. So 2 rupees company can call it on application, then 3 on allotment. So if 7,000 shares, only 2 on application and allotment has been called up, means total 5 rupees has been called up. So called up capital is 7,000 multiplied by 5, 35,000. So the part of the subscribed capital which company has actually called is known as called up capital. Now, let's say company has called up 5 rupees, but there is a person who only paid 2 rupees on application and he did not pay the allotment amount. So there is another bifurcation known as paid up capital. It means out of the called up amount, what public has actually paid. Okay, so it is written, it may happen that some of the members don't pay the calls made by the company. So paid up capital is that portion of called up capital which has actually been paid by the members of the company. Okay, this is the example where they are saying that only 2 on application allotment has been called up and person holding 6,000 shares paid it. Okay, so paid up capital is 6,000 share, 1,000 share holder did not pay the amount. So we have received 5 rupees on only 6,000 shares, that is now our paid up capital. Apart from all these bifurcations, there is another known as reserve capital. So company can decide by passing a special resolution that a certain portion of subscribed uncalled capital shall be called up only in the case of winding up liquidation. So they can say is key whenever there is a portion for which public has subscribed, okay, but company has not called the whole amount. So company can also say that the remaining amount we will not demand right now, but we will demand if and only if the company is going for liquidation or company is going to shut down. Okay, so that is known as reserve capital, that will called up in the case of emergency only and it is not shown in the balance sheet. Fine. So this is very important. This is not shown in the balance sheet. Today's class, we will end it here. The remaining topic we will carry on in our next class. Thank you so much.